The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
What's going on? Listening to that opening bumper, plain-spoken, hard-hitting style. We still get that hard-hitting style? I don't know. We've lost our edge.
I think I'm a little softer hitting. I don't know.
Okay.
Remember, for those of you new to this show, we developed this show to answer your financial questions. So many shows we hear out there might give you one nugget or two of information, but really it's a commercial how you should come to their next seminar. And that's when the big guns come in, right?
That's right.
This is information you can use right now in your financial lives. We also, like I said, have seminars and do all that kind of stuff. We put them on the skids for a while on the back burner, but we're going to start doing that again because people like them.
And, if I can jump in, kind of like the show, a lot of seminars you go to, they give you a little bit of information to entice you, kind of like you see on TV shows. It's a teaser, but stay right with us. Be right back after the commercial. In other words, come to their office, and then they'll give you the information. I believe our seminars, like the past, will give you the information you need if that instills or gives you the confidence in us to take a look at your portfolio, review, perhaps use our financial analyzer to see if we could tweak it and make it better. Then we'd love to have the opportunity. But like the radio show, the seminars will be informative and not give you half of the information.
That's right. I know some advisors, a bunch of big advisors, they'll do an analysis for you, let you see it, but they won't let you have it.
I know.
Unless you become a client, you can't have it unless you pay them like $1,000.
Yeah, or more. That's right.
So we don't do that. There's never an obligation to talk to us for us to do a retirement plan for you, a Social Security optimization plan, any of those, a portfolio analysis, any of those things we do for you, and we let you have the information to take home with you.
Yeah, one of the things I always tell our clients, new clients that are just getting familiar with us, getting welcome to the team, is please don't hesitate to call us. We do this all day, every day. We enjoy what we do. We've got a passion for it, and it's never a bother.
Yeah, the Guy and I have both been doing this over 25 years, almost 30 years apiece. Long time. I keep showing our age.
If we knew then what we knew now, it would be awesome, huh?
I've only done two things in my life. I was in nuclear chemistry in the military, and I've been doing this for the last 30 years. To me, I take the kind of approach, like an engineering type of approach instead of a sales type approach. I know might not know what that means. What it means is the math has to work. I can't stand a sales pitch that tells me this is the greatest thing in the world. You need to do this right now. Everything else is terrible. Well, anytime somebody does that I know they're just selling. I want to give you, here's the numbers. Here's your actual numbers in your portfolio. Here's if it makes this return, this return, this return. Here's if you need this much income, and this much income. And here are the outcomes to all of those. And what I say is if you can drop 10% in your expenses, or you can get a guaranteed income stream over here, then it lasts to perpetuity. Otherwise, you have a potential to run out when you're 78, 85, whatever the numbers are.
That's right. And don't worry about all the radiation exposure Victor had in the nuclear program in the Navy. It has not affected his judgment at all.
That's right.
Despite what you might have heard.
All those are, like I said, if you'd like to take advantage of our no cost, no obligation retirement plan, portfolio review, Social Security optimizer.
Well, maybe a little.
That's right. Don't hesitate to call 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. All right, Guy, what's been happening in the world? Well, Trump's starting to make some picks for his cabinet, right?
I tell you, the market reacts pretty quick, right? You talk about before interest rates come out, usually it's factored in unless something happens other than expected. Jobs, usually by the time the numbers come out. Earnings, unless something other. Trump getting elected. If Hillary would have been elected, it would have been the same thing, perhaps in a different direction in different sectors. But absolutely, we've gotten a little bump, got some crazy. NASDAQ earlier in the week sold off, depending on who you listen or believe to.
Listen, you put them together.
I noticed that radiation exposure. Damn it. Whoever you listen to or whichever philosophy you believe will tell you perhaps the reason that the NASDAQ corrected as much as it did earlier is people cashing in. There's been some high flyers of recent. Maybe they're taking profits. Maybe they're going to invest into some things that may do better now because Trump's in office. So, I mean, there's a lot of things that are moving and shaking.
Talking about the carrier announcement.
That's right.
Apple announced they may build iPhones in the United States.
Nabisco's talking about coming back.
So, is that good news for stocks? Is what a lot of people are going to ask. Well, sure, it can be good news for stocks. It also can't be. You can look at both sides. Some people will say for domestic things it might be better, but a lot of these companies make a lot of their money exporting things as well, which might be worse. Also, they're talking about tightening rates a little bit. I don't know if it's really tightening at this point. If they raise interest rates a little bit, I think it's more like normalizing rates.
Absolutely. It needs to do it a few times, don't you think?
You can't have it Fed funds rate at 0, basically, or I think it's a half a point now, a quarter.
Forever.
Because normally when you raise interest rates, it cools off the economy, okay? Because right now, remember, with low interest rates, what happens? People buy more houses, all right? Look at the payment on this one, because people don't buy the house price, they buy the payment. So they'll buy a bigger house if the payment's still the same, right? So they'll expand businesses because business loans are better. So what happens is when the economy gets cooled off, going too fast, and you get inflation hitting and all that, they'll raise interest rates to cool it off. But that is really a tightening, not a normalization. So the point to all that is if interest rates are raised gradually over time, it doesn't have as much of an effect as you think on the economy. It's not going to crash the thing. It's not going to make stocks go down immediately or anything like that. Don't get me wrong. Sometimes the news of an increase can make a temporary correction, but it always levels out after a few days.
And you're going to have to be careful. There's lots of commercials, and we'll talk about that a little bit later in the show. But as different things develop with a new president in office, you're going to hear marketing geared towards that to try to get you to invest into this and then to invest into that. I've heard lately small caps now are doing better because of Trump's economics and what he's planning to do, and not large caps. I've heard that there's just all sorts of different bank stocks, apparently, because of the regulations that may go away are supposed to be good investments. But the whole point is, if you have everything planned, if you've got everything in the right pocket, you don't want to disrupt it. It's just like the gold folks that always want you to invest in gold. It's the best thing since sliced bread ever. Well, if you track the returns back to the turn of the 2 centuries ago, the rate of return isn't that good. If you invest into things like that, when it hits 1,800, you have to sell to capture it, right? Now it's back to 11. It's on a slow decline down. So, I mean, these aren't long-term investments. They're things that you can have some money in and have some fun with, but you have to get out to capture and realize your gains.
I keep forgetting because, around here, North Texas,
right?
People are pretty similar as far as political views, religious views, things like that. Pretty similar in the suburbs anyway.
Sure.
And I was talking to my son. Those of you who don't know, my oldest son.
Very sharp kid.
30-year-old professor.
Yeah, kid. I'm old.
In New York. And so he's, how do you put this? Uber liberal. I think he's about 3 steps to the left of Bernie Sanders. And so he is completely flipped out. Like I said, I had to talk him off the ledge last week. He goes, "Oh my gosh, it's the end of the world. It's the end of the world. They're going to round up minorities." Oh my God. It's not the end of the world. It'll be okay. He goes, "Well, it's guys like you that voted for him." I'm like, "I'll be quiet." I go, "I'm telling you, it's not the end of the world. Things aren't going to change as drastically as you think. It'll be fine." I go, "What happens is every group comes in there and they do their thing for 4 to 8 years. They get tired of them. They kick them out. They bring in the next group." I go, "It's been that way my whole life. It'll probably be that way the whole life." He goes, "That's the way it's happened in the past, but not now. It's different now." And he's really, I'm telling you, really freaking out. I don't have those kind of issues. Remember, the presidency and all that kind of stuff doesn't have as much effect on your money as you might think. It does have some, though.
Well,
no doubt about it.
With that in mind, it's, you can take what we know and with our president-elect and some of his plans and things, and it looks like he's going to be a hard worker to get things done, and maybe some adjustments are needed. But the core and the plan, let that stay in place.
Yeah, the one thing that rising interest rates, tightening of normalization of interest rates,
Yep.
That can have an effect on bonds. Any kind of bonds can really be affected by that. So be careful when you've got your bonds, especially high yield bonds. High yield bonds get hurt a lot worse than any other kind if interest rates go against them. Remember, bonds go up when interest rates go down. Interest rates go up, bonds go down. Bonds go down.
What you meant? I got to say,
it's
though.
the opposite, whatever the opposite is. Right?
And again, within your plan, I like stocks a lot more today than I did a month ago.
Yeah, I agree with you 100%. The only thing I know is the market has not made a 9. It's made 8 years without going down. It has never in history made a 9th. That's always in the back of my plan.
Oh, yeah.
Remember, if you have any questions, folks, don't hesitate to call our hotline at 972-715-2424. You can always go to our website at ilovemyretirement.com. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. What I want to talk about next, guys, I'm seeing so many commercials out there now. A lot of television commercials, radio commercials, but seems to be more than normal are flying at me from every direction. I know how much this stuff costs, folks, and so they're spending fortunes on it. So it must be working, right?
Yeah, and I think we're going to see more and more as times progress here.
A lot of it was the rule. They changed this rule. It used to be private investments, private placements, all that, could not advertise forever. I mean, for the 30 years I've been in this business, but they just changed the rule like I think a year or two ago.
Yeah.
So now you're hearing them all. So what we're going to do is we're going to kind of pull back the curtain a little bit. Because they give you a little bit of information. You need to call for the information kit or
find out what's going on.
We'll tell you what they're talking about, and you can make a decision whether you want to call them or not. But first one, Ty Young's doing a lot of ads, and I'll tell you if I think it's suspect. Nothing wrong with the ad. I've never
probably a good guy, right?
Yeah, seems like a decent guy.
He's a hard worker.
They're talking about would you rather have a decent rate of return, but your money's protected, and blah blah blah. He's talking about index annuities.
Have your money only go up, never take the down years.
Right. Talking about index annuities. He's from Ohio or Pennsylvania or something.
Probably if you call in Texas, there's some call center in Ohio or Florida or California, and they'll route your call to the next guy in the queue in your neighborhood or your city.
And they usually split the commission with them. That's how it works.
Yeah.
They paying for the lead, blah, blah, blah. Remember, to my knowledge, we were the first ones in the United States to do those kind of commercials. So we're the original and we're local. So if you're looking at an annuity of any type and you want to get the straight scoop on it, in other words, the pros and the cons, which some of them have significant cons. Some of them, I believe, are more on the pro side. But we'll give you that information. You can call us anytime you want.
That product, like bonds, like mutual funds, like any product, like automobiles, like any cars out there, there's some very good ones, and there's some ones that aren't so good. Usually the ones that aren't so good pay the most commission, so you got to be careful of that. The other thing is you may hear and wonder, what is that? I got to call. I've had people call and ask me, Guy, I keep hearing about this 14% a year return. What is it? Is it a CD? Because they said CD-like, and it's another fixed annuity. With different fixed annuities, some will give you an upfront bonus the first year. In other words, if you put $100,000 in, they may have a 5% bonus. Your opening balance is 105, or a 10% bonus, so you'd have 110 instead of 100. So when they're promising these guarantees and high rates of return, it is true, it's a first-year rate of return, but then you have to look deeper. And as Victor and I talk about, our philosophy at Dillon Gage is solution-based. We try to figure out and spend time with you and figure out what you're trying to do, what age, when do you want to retire, what's going to work, are the kids in college, are they going to go to college, all of that stuff. And then we can back into how much money you need, if a fixed annuity is appropriate, if so, how much, certainly not all of your money. So there's a lot involved to do that. It's just not, call us, you can get 14% return guaranteed.
It's amazing. I talk to advisors that know very little about the products that they sell.
That is crazy.
It's shocking to me. Somebody asked me, I know you love annuities, and I go, 95% of all annuities I don't like. I think they have too many fees. I think that some of them have the payouts aren't as good as you could get somewhere else. So most of them I don't like. But the ones I do have been vetted through a multiple step process. Yeah. It goes down to, okay, we got to eliminate high fees. We got to eliminate too many surrender charges. We got to eliminate something that's going to, if some of them pay you this and these other ones pay you this plus 2% or something, well, we're going to look at those. And then I'll go to companies. I want companies 100 years old, at least 50 years old. I like A+ rated. All of these different things that's going through this checklist. And that's why, even though we have access to thousands of them, there might be 10 or 15 of what we're using because they fit the criteria we're looking for. To me, it's the most comprehensive filtering of annuity companies that there is out there. If you ever, like I said, if you ever have a question about one, call the source. It's 972-715-2424. Again, 972-715-2424, or you can go to our website, ilovemyretirement.com. All right, what's the next ad we've been hearing? The Bank on Yourself, folks.
Good program for the right people, yes?
Yeah. Bank on Yourself, typically, it's an index universal life or a universal life of some type. Sometimes they'll use a whole life, but it's mainly index universal life now. It used to be mostly universal life. That is different than universal variable life that's actually in the stock market. It's kind of like an index annuity, but in a life insurance policy. Okay.
For that to be ideal for you, you have to kind of be young,
right,
and you have to be in really good health to get the best rates. I gave a quote to a fella earlier today. We had with a fixed annuity, which was probably about 2/3 of what he could get tax free with that IUL.
Right.
With he was going to put $100,000 in a fixed annuity and $40,000 a year for 10 years. We looked at just putting $50,000 a year in an IUL, not putting the $100,000 lump sum, doing it for 10 years. He was about 56, and in doing that, somewhere between $35,000 and $45,000 a year at year 10, he could pull out tax-free because he's borrowing from the policy. Immediately, he got $700,000 worth of life, and then it grew to about $103,000. So again, solution-based, it can be a great program for you if it fits what you need to do.
Yeah, I've got no problem with the product. You got to remember, permanent life insurance is more expensive than term life insurance.
That's right.
You do get some benefits for that, but you got to make sure you really filter out the bad ones in that area too. And every time I hear the guys that do that as the only investment they do, it beats everything. It's great, and they don't tell you any of the cons, or they really rough over the cons. Don't hesitate to call us if you have any questions about Index Universal Life or any of those Bank on Yourself stuff. Our number is 972-715-2424. After the break, we're going to go over a lot more of the ads that we've been hearing lately and kind of pull the curtain back for you. Now, stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, folks, if you'd like to take advantage of our no-cost, no-obligation information kit, portfolio review, portfolio retirement plan, or Social Security optimization plan, all services we offer at no cost or obligation, don't hesitate to call us at 972-715-2424. Again, 972-715-2424, or you're welcome to go to our website at ilovemyretirement.com. All right, we're talking today about commercials we're hearing, and what we're trying to pull the curtain back a little bit and tell you exactly what they're talking about.
And before we go to the next one, Victor, I'd like to really, for the point of emphasis, mention what you said as we were going to break. Hopefully you're still with us from break. But Victor brought out the point with these programs that when you go to somebody that only carries life insurance, or they only carry annuities, no matter what your problem is, that's the solution. And as you can kind of tell, and if you can't, again, we want to emphasize and show you that there's some great places where these can be used, but there's also some places where it won't. The IUL, the Bank on Yourself we talked about, if you're too old, if you're not in good health, and golly, the tables for what you should weigh at your height, those are, you can be 20 pounds overweight, still be in really good shape, and your rates are triple what they should be, and you're disqualified. But anyway, if you're not in good health, if you've got too many meds, if you're too old, it won't work for you. So it's not the right thing. And if that's all you sell, that's what you're going to get. Annuities, same thing. If you don't need income, if you're in perfect shape, period, it may not be the right thing for you either.
I think that's what we pride ourselves here at Dillon Gage. We pride ourselves in giving unbiased advice, much as we possibly can. It's impossible to get unbiased advice from a financial person that sells one financial product.
Absolutely.
They can even be the best. They might be the greatest people in the world. They might go to church with you. They're fantastic. They're a deacon, whatever. It doesn't matter. You can't be unbiased if you sell one thing.
And the same thing applies to a new guy in the business. Not because there's anything wrong with him, not because he's trying to be crooked, but he hasn't been in long enough. He doesn't have the experience. All he knows is what his supervisors kind of pointed him the direction in. And usually, even up to age 30, 35, they have a handful of things they're familiar with, and that's their universe. So therefore, it becomes your universe.
Well, we're talking about ads today. We're here and trying to pull back the curtain on them a little bit. There's a lot of those Wall Street type ads. I'm going to show you my trading system.
That's right.
What is it? Dump the broker. Get rid of the broker. We can help you in 2 hours. We're going to train you how to do it.
Who can you trust the most? Yourself?
That's right.
That sort of thing. Yeah.
Those are just trading deals. Like I said, if you want to be married to a computer screen, not make the returns they're talking about, because I've got a lot of my clients have done this before. Because a lot of people have the thing in the back of their head, they always kind of wanted to do stock trading or something like that. And so this helps you do it. But I've never seen them work long term. I've never seen a trading program work long term. Is it possible? Sure.
The intoxicating part of those is, one, you're in control.
That's right.
And two, you've got a lot of potential, and you can't plan on potential.
Right. I had one person that actually did it. They came back to me a year or two later.
I remember.
Did it with me, but at first they said, I'm going to try this. And they came back, and they actually liked the person that was doing the They really did, but they go, truthfully, it wasn't what they were saying. I didn't make the returns. It was a lot more work than they said.
And I don't think they lost anything.
They didn't lose anything.
They were kind of like even, which is a pretty good feat.
But, I retired for a reason. I don't want to work 10 hours a day, and I was having to do that just to make it a little less than what they were saying.
And this guy was a brain, too, right? Like an engineer type, the whole thing. So, I mean, he really devoted himself to it.
You got to be careful. Those aren't scams. I just think it's misleading. They don't make money trading the market. They make money selling you trading the market. Yeah. Just like those real estate guys. I'm going to teach you my secrets. How I became a billionaire in real estate. They most of them became rich by teaching you how to do something. In other words,
if they really knew everything and they had a program,
why would you never hear about it?
That always worked.
That's right.
You'd never.
If somebody knew how to trick the stock market into working all the time. Think about the largest endowments in the world, your Harvards, your Yales, and all that. They have the smartest people on the planet manage their money. They've never figured out a trading program that beats the market ever yet. Somebody's selling me something on the television.
And what do they average with 1,000 of the sharpest minds working on them, you think?
Like 7 or 8, which is not bad.
Right.
It's better than average.
Tell somebody you get them 7 or 8%. That's not enough.
Well, you got the reverse mortgage ads out there. They're not bad. Reverse mortgage if you have to do it.
Yep.
If you have a choice and you have plenty of money outside, don't do it because they're only going to loan you a certain percentage of the house. Rates are a little higher. Fees are higher. So I wouldn't consider it unless you have to. Somebody goes, what do you mean if you have to? Well, you got this many bills. You're short $1,000 and they'll give you $1,200 for reverse. You'll cut your bills $1,200. That makes sense. The other one is I hate annuities and so should you. You've probably seen those ads everywhere.
What a great campaign.
It's a fantastic market.
If you've read that ad, call us, please.
That's Ken Fisher. He's the money manager. I think he's out of New York or Chicago. I can't remember.
Sounds right.
We'll talk more about that when we return from the break. Remember, don't hesitate to call us if you'd like to take advantage of any of our services or have any questions. It's 972-715-2424 or go to ilovemyretirement.com. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome. Remember, that is my motto. If you really think about investing or anything else in life, if you really break it down to its common sense principles, it'll save you a lot of heartache and a lot of money. Because a lot of people, they always chase the winner, When is the most money coming into the stock market? At the top. When is it all flowing at the bottom? It's just what people do. We're talking today about the commercials you're hearing out there. We're trying to pull back the curtain and tell you exactly what they're talking about, or the good and the bad. Remember some of the real estate ads I'm hearing, some of the shows. There's nothing wrong with real estate. I own real estate. I own several pieces of real estate. Nothing wrong with real estate. But when they tell you it's the end all be all for everything in the world, you should never touch anything but real estate. Only rich people in the world are real estate. They're just selling you, trying to sell you real estate or a program to teach you to buy and sell real estate.
We've worked with a lot of people that are in real estate or know people that are in real estate, both residential properties, and I've got a client that was heavily into commercial properties. I think his income off of them was somewhere near 70 or 80,000 a month. And believe me when I tell you, if you take one of these courses and you want to get involved, for you to be successful, and you certainly can be successful in real estate. Lots of money has been made in real estate. It is absolutely a full-time job. Probably not a 40-hour-a-week job. Probably a 60-hour-a-week job. And if you take it that serious and you do your homework and you buy right, you watch your cap rates, all that stuff, you can be very successful. But it's when they start telling you, you can do this part-time in your retirement. If you're going to do it, forget your retirement. You're not retired, right?
Right. Put your common sense hat back on.
Right.
Anytime you hear something like, you can trade like the pros.
Same
We're going to
thing.
make millions of dollars you can put 10,000 in and make millions.
Part-time.
Yeah. When you put your common sense hat on, you're like, get out of here.
Yeah.
Same thing with that. There's nothing wrong with real estate, but the claims they're making. Plus, I hear this one. I heard it again the other day. Sell your IRA. Don't close out your 401k. That's the worst advice I've ever heard in my life. Anybody ever tells you not to contribute to a 401k and to send it to them instead, or to close one out when you're under 59 and a half, is not looking out for you. They don't care about you. They're just trying to make a sale.
We talked about this last week, Vic. They don't even qualify it. They say, if you're investing in a 401k, you will lose 30 or 40% because the market is going to go down. How many assumptions does that one-line statement make that's wrong?
And they get calls like you would not believe.
I guess.
You can't, like I said, just don't believe it. It's all BS. It just is. There's nothing wrong with some of the products, so that's where the legitimacy comes in.
Sure.
It's the statements they're using. It beats everything. The only way you're going to do this, don't, that government money, they're going to raise taxes. Just get rid of it. I remember the one kept telling people to quit their job if they're under 59 to get access to the 401k so they can put it in their deal. It's ridiculous.
If I'm not mistaken, at least the one I heard where it says, if you're investing in a 401k, you will lose. That one, I believe, was an indexed universal life. It was a life insurance similar to the situation or the scenario we gave you in the first segment today with the tax-free money and you borrow. And we know the issues with it. You got to be in good health. You got to be fairly young. You got to put a substantial amount away each and every year for probably 10 years. And if all that criteria is met, it could be really good for you. But keep your IRA.
Oh, the one said, the one commercial says, it'll beat the pants off your 401k or IRA. Beat the pants out of them. And I'm like, that's just a,
you know what the truth,
to me, it's crooked. You can't be doing that.
We've had segments on this. You know the truth is, don't you? You can't invest in IRA in life insurance. So for them to get you to invest, and if your money's in an IRA, what do you have to do?
Get rid of it.
Exactly. Oh, gee, what a coincidence.
Who cares if you lost half of it in taxes?
Oh, well, yeah. Hey.
Because that wasn't your money anyway. It was the government's anyway. That's what they tell you. I tell you that crap. The only other ad right there about a lot of gold ads lately. I got nothing wrong with gold. We're part of this group, the Dillon Gage here, and they've been one of the largest wholesalers of precious metals in the world. Nothing wrong with gold.
International company.
I just don't like the way it's sold. What they'll say, if you want a safe haven, well, gold went from 2,000 to what, 1,100, 1,200? How's that safe? It goes back and forth. There's not they said they hedge against the dollar. The dollar's going to be worthless. It's not really a hedge against the dollar. It's not really a hedge against inflation. It used to, a long time ago, it kind of moved back and forth when the gold, it doesn't anymore. It's kind of a fear gauge. When people are real scared, you'll see gold going up. When people start feeling okay, it goes right back down. That's the way it is.
And we've talked about it. If the market gets apocalyptic, if the world gets apocalyptic, it's probably better to have lead than gold.
Yep.
Real quickly, I know we're getting close for a break. Went to visit some friends of ours in Austin for Thanksgiving, and they've got a bunch of gold. both him and his wife, and I likes cars and the old muscle cars and the antiques, and we got to talking through the course of dinner, and he said, maybe I should sell that gold and get cars. I said, well, yeah, that's a good investment. Makes sense to me.
Just remember, put your common sense hat on. Always put it on, and you'll weed out a lot of this crap. When anybody tells you there's only one thing in the world you should do, and it's this, that's probably the thing you shouldn't do, or at least not with them.
But look at gold as a commodity. It'll go up, it'll go down. You got to buy right, you got to sell right, and if you do all those things, great.
Right. The only ads we haven't heard lately are the oil and gas type of ads. How they were really abundant until oil crashed.
They're talking about cutting it back now,
That's
production.
Right. OPEC cut a deal, first time in 8 years that they've actually been able to come up with a deal. So that means, and it's been rising anyway.
Yep.
What's crude oil up at $50 or something, 40
Yep.
something bucks?
Yep.
And so now the companies start getting profitable again. They can start advertising. So you should start hearing the oil and gas rates. Remember, oil and gas is nothing wrong with oil and gas. You got to be careful though. These are not financial advisors most of the time. It's just a salesman that could come out of the pen and be the number one private investment salesman in the world because there's no regulations, no licensing on a lot of them.
And you're going to hear about the tax write-off and your tax credits if you invest, and there's the hook.
Just be careful. If you have any question about an ad you heard, something a broker sent you, we'll be more than happy to tell you what they don't and what they wouldn't. Call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. We got one more break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show, folks. Remember, this show is developed to answer your financial questions. So anytime we have questions we know that come in from the phone calls or the personal interviews or whatever, if we know it's going to appeal to a larger audience, we'll share it with you. We always don't name the names. A lot of people make up names anyway to make it feel like it's real. Believe me, these are all real, but we don't want to put people's names on the air. So if you have any questions and you'd like them, read on the air, don't hesitate to call us at 972-715-2424. All right, Guy, what's our first question?
Bob Tigert from Louisville, Texas. Oh, I wasn't supposed to say that. Has a question. All right, first question is, this is a tough one. Lots of things. What is a reasonable fee structure for money management?
Oh, I guess that can be subjective. Some money managers will say, as much as they're willing to spend, right?
Yeah. Then you got dollar volume breaks, right? You got price breaks.
It depends. The only thing I would worry about, like standard is about 1%, okay? And most people are put in mutual funds. And sometimes they're put in retail mutual funds. And the fees inside the retail mutual funds, when you add in management expense, turnover costs, which aren't really disclosed, and all of that, you could be paying a couple percent in management fees inside the mutual funds, and you're paying somebody 1% to 2% to pick the funds for you. So you could be paying 3 or 4% in some managed accounts. Too much.
And then you have soft costs on top of that.
That's right.
Many times.
That's too much. Now, if you're paying 1 to 1.5%, maybe 2, if it depends, and you only bought ETFs or individual stocks, now it's getting a little more reasonable. I know everybody wants to pay 0.5%, and if you have enough money, you can. But for the average person, they pay about 1.25%, something like that. Some people charge more. We here charge 1%. We put you in ETFs though, but we put also in managers, institutional money managers, because honestly, your broker, me, anybody else, it's going to be tough to compete with an institutional advisor, institutional money manager that has 10 PhDs, 2 economists, 2 CFAs.
They have wide, diverse teams.
They've got everything. They're not geared to marketing like 90% of advisors are. So I hire the best, and that's who manages money for us at Fidelity.
And why do I have to pay you 1% to hire the best? Why can't I go to them directly? Well, the answer is and we, again, as Victor said, use Fidelity as our platform, but a lot of these guys have high minimums. They want $50 million, $10 million, $20 million. If you have that amount of money, they'll be happy to sit down, give you their time, and you can be part of the team. Most people don't have that amount.
There's a Jackson fund that's $400 million minimum.
Minimum to get in.
Yeah.
Holy cow. That's
So
a
you
select
can't go-
club.
But the reason why I go, these money managers, what they want to do is they want to manage assets. What do they not want to manage?
People.
People, no clients. That's why you're splitting fees with them, whatever. They're managing assets. They're just managing you. And the reason you need an advisor and an intermediary in there is no advisor is ever going to tell you, no, we're not doing too good. You should move your money over here.
That's a very good point.
We will. We monitor the managers.
That's right.
We produce the mix of managers to give you the right allocation. Because not only you need to diversify assets, sometimes you diversify managers as well. Because you want to get different types. Sometimes you have a growth manager, value manager, or sometimes a manager is really good and well known at growth, but not so much at value. Same thing with fund companies. I think if you have all your money with one fund company, you're not going to get the best, because sometimes a fund company is really known for, a lot of fund companies are known for like fixed income. They're really good fixed income houses. They've got equities, but they're not really good at it. They're not known for it. So I want to go to the best of the best when we manage your funds. And that's what we do here.
Now, whether you're paying 1% with us or 3% for someone that's managing a mutual fund for you and you've got other costs, you still need to audit your accounts. The most important thing is your rate of return. And how do you tell if you're doing well? Well, what you want to do is take the portion of your portfolio that's in the market, not the whole portfolio, because you probably have bonds and safe things that are weighting down the performance. So take your market part of your portfolio and compare it to the S&P. If you're doing as well or close, and you're probably okay. If you're outperforming, and obviously that's an easy answer. But if you're if you're significantly less than that, then you need to rethink what you're doing.
Right. That is a good rule of thumb.
Easy way.
Just now sometimes the S&P 500 might be led by a certain asset class, and you're not as weighted in it.
That's
blah,
true.
blah, blah. And so you got to be fair, and it's got to be over long term. That's one thing I have when I've been training, I've been teaching people about the market for 30 years, is people have a short-term mindset. That's just what it is. I want it now. It's just a different world. Now we got access to news now. I got 300 channels on my DirecTV. Instant. They got to have it now. Remember, I was trying to figure out how tall LeBron James was the other day, just talking to your phone, boom, it comes out.
That's right.
And so, but because they have that mentality, what they'll do is they'll say, all right, I've done this for 6 months. And I've lost the market. Horrible plan. Change it all.
Yeah.
And you got to be more fair to yourself in that instance, or to your advisor in the other. But if you've given it a long time, like I had somebody goes, I've had this manager for 10 years, hasn't made a penny in 10 years. I go, well, that's the time to definitely look elsewhere.
Now, if you've lost 15% in 6 months and the market's made 15, regardless of your asset class, someone needs to change something now.
That's right. So some of that stuff you can kind of figure out on your own. But don't be so short-term. Like I've had people tell me, well, I'm going to change this. And I've talked them out of it to stay with the other advisor.
Sure.
Because they go, well, market's made 14 and they only made 12 in the last 6 months. So I'm pretty much firing them. I go, there's a whole lot else here. You have more diversification, et cetera. I want to thank everybody for listening to the Common Sense Investing Show today. Remember, if you have any financial questions, you'd like to take advantage of our no-cost, no-obligation retirement plan, portfolio review, Social Security Optimizer, don't hesitate to call our hotline at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure, and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.